In this presentation, we will create an invoice and apply a credit to it. In other words, in a prior presentation, we recorded a deposit, a prepayment from a customer, and advanced payment for a customer for a down payment on what we sell inventory, a guitar. And in this format, or in this presentation, we will now create the invoice, applying that credit to the invoice within QuickBooks Pro 2020, QuickBooks Desktop 2020. Here we are in our Get Great Guitars file. We currently have the Open Windows open. You can open the Open Windows by selecting the View dropdown and the Open Windows list. In a prior presentation, we had entered a deposit into the system as customer deposit. And you'll recall this happens in our case because we had a down payment for a guitar that we currently couldn't provide. And therefore, we said, hey, if you give us a down payment, we will get that guitar ready for you, and then we'll invoice you in the future. This is a similar kind of transaction that you would have on something like rent. If you had a prepayment of the rent or a security type deposit on the rent, you got money from a customer before you did, or when you didn't do any work in that case, or before you do work, and therefore you can't record revenue at that point in time in accordance with the normal accrual accounting standards. So what did we do instead? We, in our case, recorded a receive payment, and now we're going to apply the create invoice to it. So let's recap that by taking a look at the financial statements, see where we are now. Then we will create the invoice and apply the credit to it. So how did the credit get there? Well, let's go to the reports up top. We're going to go to the company and financial. We'll take a look then at the balance sheet report. We're going to change the dates up top in the company reports. We're going to change the dates from 01/01/20 to 12/31/20. That's January 1st to December 31st, 2020. Okay. And then we're going to say that normally when you have a prepayment, note that under normal accrual accounting, what will typically happen is you will debit cash or undeposited funds in our case, or cash, and the credit will not go to revenue because you got paid before you did the work, but go to something called unearned revenue or deposit or some type of liability account. That would be what you'll typically learn for unearned revenue or prepayment or deposit, how to record it in normal accounting using debits and credits. The problem with QuickBooks, however, is that when we get a deposit from the customer, we want to be able to track that deposit and match it out in the customer tracking fields, and the customer tracking fields aren't usually in unearned revenue. What we want to do is be tracking them out in the account that tracks the unearned revenue. That is accounts receivable. Why? Because accounts receivable has a sub account to it which will track the information by customer. In other words, if we go to the reports up top, if we go to the customers and receivables, and we go to the customer balance detail, this is the detail supporting the accounts receivable, tying out to the end balance of accounts receivable, and it shows all the customers in it. In other words, we would like all customer activity to be in here. Normal customer activity is that they owe us money, not that we owe them money. In this case, we owe them money for a short period of time. So it's useful for us then to record a negative receivable, as we have done in the past here. This is kind of a common practice. You'll see this in many practices, although it's not what you learn in financial accounting, and the reason is because in financial accounting, all you're dealing with is the main accounts, the GL accounts. You're not really thinking about the customer accounts here. And if you're thinking about the customer accounts, the subledgers, and how to tie out the customer account, you may come to the conclusion of doing it in this format, which is common that you will see in practice. Now, it's still fine for accrual accounting. It's just not what you're typically learning to see. It's not technically correct from an accrual accounting standpoint now, but just like many other things that aren't correct from an accrual standpoint, what you'll do at the end of the month, if you want to do the adjustment, as we will see, is simply make an adjusting entry at the end of the month, just like we would with other types of adjustments for timing differences at the end of the month. So we'll just make an adjusting entry. So we'll see that at the end of the month. So what we have then at this point in time, instead of a liability account, we have a negative receivable within the customer field of the Anderson guitars that represents money that Anderson gave to us, which we couldn't yet record as revenue because we have not yet received, or we haven't done the work yet. Now we're going to do the work, and we're going to apply the invoice to it. You'll notice the normal method is invoice, then payment. In this method, same thing, invoice and payment will match out. However, we're going to have payment and then invoice. And then the payment will be applied to that invoice. And so let's do that now. So we're going to go back to the home and we're actually going to create an invoice. So what we did then is we went in reverse order because we got reversed order to what normally happened. We got paid first, which is not unusual for most businesses. And now we're going to create the invoice. So we already recorded the payment. We're going to match that out now against the invoice that we're now going to create, which is in the future, right? And so we're going to say, all right, so now we're going to say create the invoice. And it's going to be for Anderson Guitars. If I select the drop down, I'm just going to type in Anderson, and there it is. The date's going to be on the 18th, so I'm going to select the plus button on the keyboard 2 times to get up to the 18th. Tabbing through this, we're going to say that they purchased an ELP, one of our standard guitars, so it's going to be an ELP. Simple process for making the invoice just like we normally had in the past. This is our normal invoice. However, they don't owe us $525 because we know there's already a credit that has been charged to us. And if you were to say save and close, I think it would give you a pop-up saying, hey, there's a credit, but we know there's a credit already. So we're going to go up top and we're going to say apply the credit. Before I do that, however, you can also see that by if you hit this item here, it'll tell you that there's an open balance, which is negative. There's a negative open balance. That's a credit that we need to apply out. So I'm going to close that back up. We're going to do that by saying apply the credit. So we're going to say apply credit. And it says the change to this transaction must be recorded before continuing. Do you want to record the changes now? I'm going to say yes. And then we have the credits. So here is the credit for the $250. That's the one we want. It's already checked off. So that's what we need. I'm going to say done. And there we have it. So now what's happening here? We've got the $525, the total amount billed, but $250 was already paid. They paid that in advance. Therefore, they only owe us now at this point in time $275. What's going to happen when we record this transaction? It's an invoice. Therefore, accounts receivable is going to be increased. It's going to be increased by the full amount, the $525. However, when we think about the customer balance in itself, the customer detail, they're not owing us $525. They only owe us the $275. So in other words, the accounts receivable will go up by the $525, even though it'll be washed out on the detailed report for the customer down to the $275. Then on the other side of it, we're going to have the sales. The sales is going to be increased by the $500. The difference is going to be the $25. That's going to be on the sales tax payable, a liability account. Then we have the cost of goods sold. The cost of goods sold, which is going to be decreasing the inventory by the cost of the inventory, not by the $500, but by the cost, which we could find if we went to the inventory item list. And then the cost of goods sold, the expense account will be going up by that same amount. Let's check it out. We're going to say save and close. We'll then go back to the balance sheet. And our main concern here is with accounts receivable. What happens with accounts receivable? If we double click on the accounts receivable, we see that we have that $525, the full amount, the $525 going up here, but it's really matching out against this negative. There's the payment, there's the invoice. So the difference between the two is that. So if we double click on that, that of course is the full amount $525, not what's owed, but the amount that we billed, the $525. Closing this back out. Then if we go to the customer balance detail, we see for Anderson here, there's the $525. Again, the full amount being recorded for the invoice. The invoice full amount is $525. Of that invoice, we have applied a payment to it. It just so happens that that payment was made before the invoice of the $250, meaning that Anderson now owes us $275. So you'll notice that whole business of having a negative receivable now washes out, and it's not a problem anymore. Now we're back to, it's just a timing difference. We're back to the normal standpoint. The only time it would be a problem is if it became to the end of the month and you wanted to make a financial statement that's on an accrual basis and break, then you'd have to break out that amount that's going to be a negative receivable to a positive liability. So then if we go back to the balance sheet, we can see the rest of this. I'm going to then say that the other side of this is going to be on the profit and loss report. So if we go to the drop down for the reports, we go to company and financial profit and loss standard, changing the dates up top from 01/01/20 to 12/31/20. We then have the merchandise sales, double clicking on the merchandise sales. We will then get to that 500 rather than the 525. Double clicking on that, that's going to be the sales price, not including the sales tax, the difference of 25 being the sales tax. That'll be in a payable account. Closing this back out, closing this back out, back to the balance sheet. If we go down to the payable account for the sales tax payable, there it is. Double clicking on that, there's the 25. So there's going to be the 25 sales tax. Closing this back out, closing this back out. Then we have the inventory decreasing. So inventory is going down. There's inventory, double clicking it. It's going down not by 500 or 525, but by 400. That amount, double clicking on it, not on the invoice, even though the invoice is generating that amount because the invoice is populated by this item. That item is what tells QuickBooks to allocate the cost to decrease the inventory. Closing this back out, closing this back out, the other side of that on the profit and loss income statement type report. Scrolling down to the profit and loss, we have the cost of goods sold. Double clicking that, we get in the cost of goods sold, and there's the 400. Double clicking that 400, there's the invoice. Closing this back out, closing this back out. This might be easier to see on the trial balance, and that's where we'll also go to check our numbers. So I'm going to go up top. We're going to go to reports. We're going to go to accounting and taxes. Take a look at the trial balance. And then within the trial balance, we will change the date range from 01/01/20 to 12/31/20. And here are our numbers at this time. And you can go through these and just basically review the numbers. And just note that the trial balance is probably the easiest place to go to review the numbers and do that kind of back and forth that we just did. But most people will do that with the balance sheet and the income statement.